Let's talk about the market. Let's talk about the S&P 500. Let's talk about this squiggly line above it here, which is very important. The percentage of S&P 500 stocks above their 200-day moving averages. And let's talk about this squiggly line beneath it, the volatility index, the fear index, the VIX. And let's visit the Nasdaq, which is wallowing a little bit behind because of the FANG stocks. We'll look at it at the stocks above its 200-day. Let's pay a little visit to the U.S. one-year Treasury yield. I'll explain why that's important in a minute. Let's look at the Dow Jones, which has been ripping off the lows in what we call a frozen rope. And let's visit Zoom as an example of the stealth correction. We need to talk about that when we talk about the S&P 500. And then if you make it through all of that, I'm going to show you a stock that is breaking out right now in a beautiful double bottom, and I'm really excited about it. Hi everybody, Joe here, Joe's Investment Express. Two things I want to tell you. One, if you want to see my current portfolio and focus list, every weekend I post that on my Patreon, $5 per month. Link in the description and in the comments. And two, this is not a recommendation to buy any of the index ETFs or any stock. It's just for entertainment, just for education, just my opinion on the market. So I'm going to continue to say, as I've said for about a month now, that the bottom is in. The market crashed for almost a calendar year. And when we had this huge, this is the S&P 500 one-year chart. When we had this huge bullish engulfing day, which engulfed the previous 3 days on big volume, when you see that after an extended downtrend, if you look anecdotally at whether it be indexes or charts, that almost always marks the bottom of a downtrend. And then it's just a question whether it's a bear market rally, or the start of the new bullish uptrend. In my opinion, it's the start of the new bullish uptrend. Why? The biggest argument I have is that this crash hasn't been going on for 1 year. It's been going on for 1 year in the mega caps, in Amazon and Microsoft, Meta and Google, etc. But most of the stocks, it's been going on for close to 2 years. If we look at Zoom, so the index has rolled over. The S&P 500 was December, and I think the Nasdaq was November 14th, somewhere along those lines. But if you look at Zoom, so the indexes crashed in November of 21, but the majority of stocks began rolling over in October of 2020, a full year earlier. And that's why the majority of stocks are bottoming now. And you combine that with the softening rhetoric from the Fed, Jay Powell, it makes sense that the market is bottoming. So now we are at Judgment Day in the S&P 500. It made this big head and shoulders top, and which ultimately did fail. And here's our nice delineated trend line, the big blue line. It crashed about 28%, by the way, the S&P 500. And as you can see, like I said, it's Judgment Day. In these previous bear market rallies, it has rolled over. The last one literally right as it hit the 200-day. The one before, shortly after. And we are butting up against this lower trend line. Every technical analysis with a 5th grade education can see that, right? We just blasted through the 200-day from Jay Powell's latest remarks, and we retested it. It's trying to stay above it. So what we need to see is for it to power through this trend line, maybe pull back, retest it, and move up a little bit more, then I'm going to declare we are out of the woods. Although we really need a higher high. So we've been making lower lows and lower highs. So we need to make a high higher than the one we saw August 15th. So the VIX, this measures the fear in the market. And when it gets into the 30s, the 30, 34 or so, that has been a marker that it's been the marker of the valleys in these indexes. Should we be so unfortunate as to roll over? Should this only be a bear market rally? And should we turn down from here? Then you could watch the VIX for when the VIX comes back up to 34 or so. That would be your indication that it's probably about to turn around again. Another thing that really makes me optimistic is, so these indexes are weighted by a market cap. So a handful of stocks control the index. Much, even though it's the 500, there are just a handful of stocks that, to a large degree, control the price. But what we see here, this is the percentage of stocks above the 200-day moving averages. The saying goes, nothing good ever happens below the 200-day. When a stock is above its 200-day, it is said to be in an uptrend. And as you can see, it had been falling all year. At its low, at the October low, only 10% of S&P 500 stocks were above their 200-day moving average. That is shocking, right? But when all the buyers have been, when all the, sorry, confused myself. When everybody who wants to sell sells, then what's going to happen? It's going to start going up again as buyers move back in. And now 65% of the S&P 500 stocks are in, above their 200 days, are in uptrends. That's a sign of a healthy market to me. Let's look at the Nasdaq. Similar, it's lagging a little bit behind the FANG stocks, which were market darlings for what, 10 years, 20 years? I don't know. Have suddenly become, beaten down. The mutual funds are pulling their money out of them and parking them in oil and the commodities and the big cap hardware companies, etc. So this has been lagging behind, but it did print that huge bullish engulfing day on the same day. I believe that it has bottomed as well. What we want to see is for it to come up, challenge this downtrend line, challenge the 200-day, push through. It's definitely the laggard. I bought a little bit of both of them when it hit this, when it printed this bullish engulfing day. If you were only going to buy one, at this point, you definitely would want to do the S&P 500. The ETF is the SPY, SPY. Or the diamond, the Dow, DIA. We'll get to that in just a second. This is the one-year chart of the Nasdaq, by the way. Here's the percentage of Nasdaq stocks above the 200-day, and it is not nearly as good, right? The S&P 500, we said 65% of stocks are above their 200-day, 65% are in uptrends. In the Nasdaq, only 35% of stocks are in uptrends. The majority of stocks are still trending downward or bottoming, hanging out beneath the 200 days. And this is the Dow Jones. It is composed of 30 great big public companies. So it's a much smaller index, but it's quite diversified. I actually did a video dissecting the Dow where I do technical and fundamental analysis of the 30 stocks. I will stick that at the end of this video. You should check it out. And this has performed the best of all the indexes in the last month, up 20% in a month. That's pretty good performance, right? If you jumped in on this huge bullish engulfing day, and it is well above this downtrend line. It retested it, bounced off. It's well above its 200-day. It's really looking very healthy I would have, the time to buy would have been right here, and then again when it bounced off of that trend line on November 18th. So now if you are really a technical precise trader, it's definitely extended. You'd want for it to pull back a little bit. But if you were thinking long term, if you were thinking 5 or 10 years, then you certainly could start easing in and buying it, you know, once a month, once every couple months. Here's the 20-year chart on the Dow, 20-year chart on the S&P, up and to the right, 20-year chart on the Nasdaq. Looks like I did some previous analysis on that. All right, what else do we want to look at? The 1-year U.S. Treasury yield. We want to see this thing trending down. And as you can see, over the course of the market crash, it ripped higher the first 4 or 5 or 6 months, and then slid into, what is that, 30 degrees. But if you look now, the last couple months, it is flat, and it is threatening to break down. We want to see this, as this yield goes down, more money will gravitate into the market. Wow, so I forgot to go over the game plan for the next couple weeks. My game plan, what I'm going to do, I'm going to splice this into the video. Hopefully it won't be too disjointed. So, unfortunately, what we want is for stocks to go up based on the value of the companies. If the company is posting growing earnings and sales, it goes up. If the opposite is happening, it goes down. But right now, we are, to a large degree, at the mercy of whatever Jay Powell says, right? And so his next meeting is December 14th. So that gives us about, well, let's see, 5, 6, 7, 8, 9 trading days. What it's going to do during these days, gosh, if I had to guess, I would say it's going to creep up a little bit. Now, we actually don't want it to run up. Jay Powell doesn't want the market to run up, because that if the market runs up, people have more money, they spend it, and that increases inflation. So the best thing would actually be for the market to slide down or drift sideways until that meeting, which would give Powell a little more it might give him, gosh, I don't know why I can't think today. It would give him another reason to be more dovish. So right now, there are some value stocks ripping off of their lows in frozen ropes, like the Dow. That frozen rope is just when it just goes up at a near vertical line with no rests, like a rope, and you can't really get in. So there are some stocks making these value type moves. That's not the kind of moves that I play, but you bottom fishers, do your thing. And then it's, other than that, it's really a stock picker's market. Biotech has been doing well. There's many good, strong biotech stocks right now. Some tech, a lot of insurance, some utilities. So you got to look for those unicorns, those diamonds in the coal mine, so to speak. And so then we're going to get some important economic reports on December 13th, and those undoubtedly will move the market. People are going to guess what Powell's going to say based on those economic reports. And then on the 14th, we'll see if he does 0.5 like everyone is thinking now. Heaven forbid he does 0.75. That's going to scare the heck out of the market. But just as important as how much he raises rates is what he says. And we just got to hope that he says they're going to back off a little, or slow down, or wait and see, something like that. And that, in my opinion, will really trigger the new bull market in earnest. Conversely, if he is Jay, bring the Powell pain, and says we got to stay tough, we're going to keep, keeping interest raises high for the foreseeable future, etc., then that could tank the market. So personally, on, let's look here, the 12th, probably the 9th and the 12th, I am going to probably do some selling of individual stocks, some trimming, if you will. I'm going to raise stops. I'm going to have some hard stops in place. The good news is he makes that announcement midday. It's 11 o'clock on the West Coast here, and it's probably like 1 o'clock or 2 o'clock on the East Coast. Let's see. Yeah, 2 o'clock Eastern. So we don't have to worry about an overnight gap. That's the game plan, and now we'll jump back into the rest of the video before this video. And if you are still with me, let me show you one stock that I recently moved into, Hudson Technologies. Let me show you the fundamentals first. Hudson Technologies provides refrigerant reclamation, sales, and decontamination. Just a good old-fashioned company that's doing a valuable service. And as you can see, here's the earnings, strong earnings. It has tapered down, but the earnings are still at 65% growth, 150.65, and sales also are tapering down, but 48% is certainly very strong, and gross margins are going up, 30, 39, 45, 54, 55. So we want to see these numbers trending up, not down, but very impressive. And we had this huge breakout year from earnings. Sorry, I have a cold. Bit sniffly today. From 2021, 69 cents earnings to 2022, $2.17 earnings. That's a huge jump in earnings. Tiny PE ratio of 6. No dividend. I was hoping it offered a dividend. And as you can see, here is the 5-year chart. It's been in a really nice uptrend the last 5 years. This is the 20-year chart. Certainly, this hasn't been a 20-year hold like some, Apple and so forth were. But the last 5 years, it's really been ripping. Now, if we look at this year, what we see is a page right out of the Technical Analysis Handbook, the double bottom. We see a nice uptrend. We see a nice even atom double bottom. The second V undercuts the first. It catches support right at the 200-day. That's not a coincidence. All of the technical analysis, big and small, those who are advising the mutual funds, buy off of the 200-day. And then it made a handle. The handle drooped down just a little bit. And now it is trying hard to break out. I would say, a lot of stocks are popping and squatting, as Mark Minervini says. Here's your pop and squat, just due to the weakness of the market and due to some institutions seizing these breakouts as a chance to sell. But we do have some good buy volume here, and I would suspect it's going to make a slow move up from here. So I'm already in this stock. If it slid sideways for a couple days and then moved up again, that would be ideal. But even if it opened to the upside tomorrow, I would be comfortable adding to my position. Now, I really think that you should always use stops, 10% max. So you could do an arbitrary 10% stop, which would put you almost at the bottom of this little handle, which would be a nice offer you some technical support as well. Now, since what I really would do to get beneath this handle, you'd need about 11%. So I would probably do 1/3 of my stop at 6%, and then the other 2/3 at say 11, and that would keep my average beneath 10%. We're kind of getting down into the weeds there. Well, those are my thoughts on the market and Hudson Technologies. If you want to see my other stocks, check out my Patreon. Let me know your thoughts on the market, and check out my video dissecting the Dow, which should be on your screen right now. Take care, everybody.